Okay, let's dive in. You've probably seen the headlines, right? Gold has been, well, absolutely surging,
Yeah, really shooting up, hitting record highs.
pushing up towards, what was it, $3,245 an ounce back in April 2025?
Something like that. A price that definitely grabs your attention.
For sure.
Yeah.
Especially with everything going on globally, U.S.-China trade friction, general financial jitters.
Exactly. And when you see that kind of movement, that instability, it's pretty natural for people to start asking, okay, how can I get involved?
Right.
And especially here, we've seen a big, big jump in interest around these gold-linked investment trusts, particularly in Japan.
And that's exactly what we're focusing on today. This deep dive is based around a really thorough guide we've got here, specifically about these gold trusts.
Yeah, and our mission really is to unpack this guide with you, pull out the most important bits, the real nuggets, you could say.
Ah, nice one.
So you can get a handle on what these trusts actually are, how they work, and maybe most importantly, what makes them different. Because things like fees and how they handle currency swings, that makes a huge difference.
Okay, let's start right there then.
Yeah.
The fundamentals. What exactly are these gold link investment trusts? How do they give you exposure to gold?
Well, think of them like financial products specifically built to try and mirror the price of gold.
Right.
They don't usually hold like physical gold bars themselves.
Yeah.
Instead, what they typically do is invest in other things that track gold.
Other investment.
Yeah, like overseas ETFs or ETCs, those are exchange traded funds or commodities, and those are tied to big global gold price benchmarks like the LBMA Gold Price Index.
Oh,
So the idea is when the price of gold moves globally, these trusts are set up to move right along with it, reflecting that price back here for local investors.
got it. So you get the feel of gold price movements, but without needing a vault in your house.
Exactly. No storage hassles.
Now, this guide we're looking at, it puts a massive emphasis on one particular difference between these trusts. It all comes down to currency, right? This with H versus without H thing.
Oh, absolutely crucial. You really have to get your head around this. Because gold, globally, it's priced in US dollars.
Right.
So the dollar-yen exchange rate, it's not just some side issue. It's like a core part of how these trusts perform when you measure them in yen.
Okay, let's unpack that slowly. First, without H, what does that mean in practice?
Without H just means there's no currency hedging going on. Simple as that.
So the trust's value is tied to.
Two main things. The gold price itself in dollars and whatever the dollar is doing against the yen. It's exposed to both.
I think I see. So gold goes up, that's good.
Yep.
But if the dollar also gets stronger against the yen at the same time.
Then you get this kind of double boost, right?
Yeah.
The yen value of the trust goes up even more. A nice tailwind.
But there's a flip side.
Definitely. You've got the reverse risk. Gold could be flat or maybe even rising a bit. But if the yen suddenly strengthens a lot against the dollar.
Then that currency move could wipe out your gold gains or make things worse.
Precisely. It can offset gains or even turn them into losses just based on the currency. Your final return in yen depends on both the gold move and the currency move.
Okay, that makes the with H version pretty straightforward then. It stands for with currency hedging.
Correct. These funds actively try to, well, neutralize that currency risk.
How do they do that?
They use financial tools, derivatives usually, to try and reduce the impact of those dollar-yen fluctuations. The main goal is to make the trust's price track the gold price itself as purely as possible, just in yen terms.
Okay. So minimize the exchange rate's effect on your investment value.
That's the aim.
Does doing this hedging cost anything?
It does, yeah. Currency hedging isn't free. There are costs involved in setting up and maintaining those hedges.
So they can drag on performance a bit?
It can be a small drag, yes. Though the guide suggests it's often pretty minor compared to the huge swings you can get from the currency itself if you don't hedge.
Okay, let's talk about the impact then. Looking at risk first. Does hedging automatically mean the fund is, safer or less risky?
Well, this is where it gets a little bit nuanced, according to the research the guide mentions.
Oh, so.
If you just look at an unhedged fund all by itself, in isolation, sometimes its price swings might actually appear slightly less wild.
Wait, less wild. How?
Because occasionally, the gold price movement and the currency movement might happen to go in opposite directions and sort of cancel each other out a bit.
Huh. That feels a bit counterintuitive.
It can seem that way. But, and this is the crucial point the guide makes, if you think about these trusts not in isolation, but as part of your whole investment portfolio.
Mixed with stocks and bonds and stuff.
Exactly. In that context, the guide says using hedged gold funds is actually seen as more effective at lowering the overall risk of your total portfolio.
Why is that?
Because the hedged gold acts as a pure diversifier. It's less correlated with your other assets that might also be sensitive to currency movements. It gives you that cleaner gold exposure.
Okay, that portfolio perspective makes a lot more sense.
Right.
Now, what about performance? How did this hedging actually play out recently? We saw gold go way up, and the yen has been pretty weak.
Yeah, this is where the guide provides some really clear numbers. During this recent phase, 2025, with the yen depreciating, the hedge funds generally did significantly better over the past year.
Really? Can you give us some examples from the guide?
Sure. As of May 2025, looking at one-year returns, a lot of the hedge funds were showing gains well over 30%.
Wow.
Yeah, like State Street, the hedged one, was up 32.90%. The iShares hedged was 33.04%. Pictet hedged 32.95%. Really strong numbers.
Okay, and how did the unhedged ones compare, the without H?
They also did, gold was rising strongly, so they benefited too, but generally their returns were lower.
Because they didn't fully capture that weak yen benefit in the same way.
Exactly. So Mitsubishi UFJ without H was up 27.36%. iShares without H, 28.21%. I picked it without H, 27.19%.
So still good returns, but noticeably lower, sometimes 5 percentage points or even more difference in just 1 year.
Yeah, it really highlights how powerful that currency effect can be, especially when the yen is moving significantly like it has been.
So the guide basically says when gold is rising and the yen is weak, the H-type funds really shine.
That's right. They lock in that higher dollar value of gold without being pulled back by a strengthening yen, which wasn't the case, but if it were.
Right. And the unhedged funds would be the opposite. They might do relatively better if the yen were strengthening while gold was also rising.
Potentially, yes. Or at least the difference wouldn't be as stark. It all depends on that interplay between gold and the currency.
Okay, so currency is clearly a massive factor. What else does the guide say is really important when you're comparing these different trusts?
The other really big one, especially for thinking longer term, is fees.
Ah, yes, the costs.
Specifically, the trustee fee. This is a cost that gets charged year in, year out, and because of compounding, it can really, really eat into your final results over time.
So basically, lower fees are better. Seems obvious, but...
It's more than just obvious. The guide makes it a central point. It strongly emphasizes finding low-cost options.
And does it highlight any particular winners on the fee front?
It does. It points to the SBI iShares Gold Fund as having the lowest fee reviewed, and that applies to both the without H and the with H versions.
How low are we talking?
Incredibly low, just 0.1838% per year for the trustee fee.
0.18%. Wow, that is low compared to many funds.
It really is. That's a benchmark.
How do some of the others stack up, according to the guide?
Well, there's a sort of mid-range group. Smart Eye is around 0.375%. The Gold Fund is about 0.407% for both types. The SMT series is 0.275%.
Okay.
Then you have the underlying iShares Gold Index Fund itself, which others might invest in, at about 0.5085%. And Pictet is around 0.539%.
Still quite a bit higher than that SBI one.
Definitely. And then there are funds with even higher fees, right?
Yeah, the guide points out a couple. State Street Gold F is up at 0.895%.
Nearly 0.5% more than Pictet.
And the Mitsubishi UFJ Pure Gold Fund, when you factor in all the related costs, effectively comes out around 0.99%, almost a full 1%.
Poof. So if you're thinking about holding for, say, 10, 20 years, that difference between 0.18% and almost 1%.
It must become absolutely enormous over time.
That's exactly the guide's message on fees. It's not just a small saving. Over many years, that compounding effect means higher fees create a huge drag. It widens the performance gap significantly compared to the low-cost funds, even if they're tracking the same gold price fairly well.
So low fees can genuinely be the difference between, like, okay returns and really quite disappointing ones long term.
Absolutely. It's a major factor in long-term wealth building with these kinds of products.
Okay, so putting the fees and the recent performance picture together, what's the overall snapshot?
Well, the guide notes that most funds did manage to track the recent gold surge reasonably well. So the tracking itself wasn't hugely different between many of them.
The main performance driver was.
As we talked about, it was really that currency hedging decision over the past year. The hedged funds generally saw higher rates of increase simply because the weak yen environment favored them.
And within the hedged group, or within the unhedged group, were there big winners and losers?
Not dramatically, according to the guide. The rankings didn't shift massively within each category. It was more about that big split between the hedged and unhedged types due to the currency effect.
Okay, that makes sense. So with all this background understanding what they are, the huge currency factor, the fee differences, recent performance, how does the guide suggest you, the listener, should actually go about choosing the right fund?
It suggests starting by thinking about your investment time horizon. How long are you planning to hold this?
Okay, so short-term versus long-term matters.
Big time. If you're looking at a shorter term play, maybe just a few months or up to a year, the guide says you really need to pay close attention to the exchange rate forecasts and movements.
Because those unhedged funds are going to swing wildly with the yen.
Exactly. They'll fully reflect that currency volatility, for better or worse.
So in the recent environment, weak yen, strong gold, the H-type, the hedged funds, were the better bet short-term.
They were definitely advantageous, as the numbers showed. But if you thought the yen was about to strengthen rapidly, maybe an unhedged fund would start to look relatively more appealing compared to a hedged one that's paying those hedging costs.
Makes sense. What about for medium to long-term investing, holding for several years?
For longer horizons, the guide kind of broadens the perspective. It suggests looking at the bigger picture things like where interest rates might be going, the inflation outlook, the long-term view on the dollar-yen rate.
And maybe use them for diversification.
Yes, and from that diversification angle, it even floats the idea of potentially holding both non-H and H types in your portfolio, spreading your bets on the currency front, perhaps.
Interesting. Okay, does the guide actually point to any specific funds as being sort of top candidates?
It does, based mainly on prioritizing those low fees we discussed and also consistent tracking performance. The guide highlights the SBI iShares Gold Fund, both the version without H and the one with H.
Would come out as the top recommendation.
Yeah, pretty much.
What specifically makes them stand out in the guide's view?
Well, they track the gold index reliably, which is job number one. But the key advantage is just those exceptionally low trustee fees, that 0.1838%.
That fee again.
Yep. The guide sees that as a massive plus for anyone looking to hold these funds for the medium to long term because it just minimizes that long-term drag on your returns.
Okay. And if someone's looking at those two SBI versions, how does the guide suggest choosing between the with H and without H?
It frames it mainly around how comfortable you are with exchange rate risk.
So the H with type.
Is presented as maybe being a bit easier, especially for beginners. It takes the currency swings largely out of the equation, so you can focus more purely on what the gold price itself is doing in yen terms. Less complexity, maybe.
And the H-less, the unhedged one.
That's seen as giving you a more direct link to the underlying dollar-gold price movements. So it's suitable if you're okay with, or maybe even specifically want exposure to, those dollar-yen fluctuations as part of your investment.
Got it. Depends on your view and risk tolerance for currency.
Exactly.
So SBI iShares Gold is positioned as the low-cost leader. Does the guide mention any other maybe mid-range options that it views favorably?
Yes. It mentions a couple of other solid options in that sort of mid-cost tier. The Smart Eye Gold Fund, which is unhedged,
Oh, okay.
and the Gold Fund, also the unhedged version, primarily mentioned there.
And what about those higher fee funds we talked about earlier, like Mitsubishi UFJ or State Street?
The guide sort of implies that while they do track gold, their much higher fees make them generally less attractive choices, particularly for long-term investors, when compared directly against these much lower-cost alternatives like SBI.
The fee difference is just too significant over time.
That seems to be the conclusion, yes.
Were there any other funds mentioned that maybe aren't easy for everyone to buy?
Just briefly, yeah. It notes a couple like One Gold, which is hedged, and Pictet Nomura SMA, which is unhedged. But it points out these might only be available through specific channels like wrap accounts or have limited sales routes.
So for the average investor, the focus should probably be on those main ones we've discussed.
That seems reasonable, yeah.
Yeah.
The ones available through major online brokers or banks.
Okay, so let's try and wrap this all up. If you pull everything together from this guide, what's the core message for someone looking at these gold trusts?
It really seems to boil down to two main things. First, find a fund that does a good job of faithfully tracking the gold index it's supposed to follow.
Makes sense. And second,
And second, maybe even more critically for the long run, keep your costs low. Focus on those fees.
and the guide specifically flags
It points to SBI iShares Gold, both the hedged and unhedged versions, and also the Smart Eye Gold unhedged, as really good examples of funds that hit both those marks, good tracking and very low fees.
Right. And for someone maybe just dipping their toe in, a beginner.
The guide seems to suggest that the SBI iShares Gold with H, the hedged version, could be a slightly simpler starting point.
Because it removes that layer of currency risk to worry about.
Exactly. It lets you focus just on the gold price in yen. But, ultimately, the guide emphasizes that the absolute best choice really depends on your own personal situation.
Like your existing portfolio, your view on the economy, your comfort with risk.
All of that. Your overall asset mix and your individual investment stance. There's no single right answer for everyone.
Well, this has been a really useful deep dive into what's clearly a hot topic right now. We've unpacked what these gold-linked trusts are.
Zeroed in on that absolutely critical impact of currency hedging, the whole H versus no H debate.
Compared the different funds out there, focusing hard on those fees, which really matter, and looked at recent performance differences.
And explored how the guide suggests you might navigate choosing between them based on your goals and time frame.
Right. And, the guide mentioned near the end that there's quite a bit of chatter on social media right now.
Yeah, about gold being that classic safe haven purchase and people viewing these trusts as potentially stable assets amidst all the uncertainty.
Which kind of leaves us with a final thought for you, the listener, to mull over. Given all the financial instability we're seeing, the currency swings we've just discussed, and now understanding how these trusts work, the hedging, the fees.
What role, if any, could gold, maybe accessed through one of these trusts, play in your personal strategy for diversifying your investments and trying to navigate these, well, pretty uncertain economic times?
It's definitely a complex question, but hopefully this discussion gives you a much better framework for thinking about it.